Hello and welcome. This is brought to you by the team at My Tax Accountant. So you've inherited a property in the UK, and that big question is probably looming. Do I have to pay capital gains tax? It's a huge one, and honestly, it's a question we get all the time. Well, today we're going to clear it all up for you.
Look, inheriting a property is, well, it's a lot to handle. And right in the middle of all that, this worry about a massive tax bill can just creep in. It's totally understandable. And that's exactly what we're going to tackle right now, using all the latest rules for the 2025-26 tax year, so you've got the most up-to-date info.
Okay, let's get straight to some good news, because I think you'll want to hear this. The moment that property becomes yours, guess what? You pay absolutely zero capital gains tax. Zero. The actual act of inheriting doesn't trigger a tax bill from HMRC. Whew, right?
But, and you knew there was a but coming, didn't you? This is the really crucial part. That feeling of relief, it's kind of temporary. Because the second you decide to sell that property, boom, that's when capital gains tax jumps into the picture. And honestly, this is the bit that catches so many people out. So here's what we've got lined up. First, we're going to cover the absolute basics, what you need to know from the get-go. Then, the fun part, how to legally slash your tax bill. After that, we'll talk deadlines and paperwork, the stuff you really can't ignore. We'll wrap it up with a quick cheat sheet and then show you where to go if you need some expert advice. Sound good? Let's get into it.
All right, let's dive into Section 1. Before you can even think about saving money, you've got to understand the terrain, right? So let's break down exactly what this tax is and how it works when you've inherited a property.
So, what on earth is capital gains tax, or CGT? It's actually pretty simple. It's just a tax on the profit you make when you sell something that's gone up in value. And that's key. It's not a tax on the whole selling price, just the gain. So, just the bit that's the profit.
Okay, now this next bit is super important. For an inherited property, you don't care what the person who left it to you paid for it, even if it was decades ago. Forget that. Your starting point is something called the probate value. This is the property's market value on the exact day the previous owner passed away. Write this down, circle it, highlight it. It's the most important number in this whole calculation.
The good news keeps coming. Everyone in the UK gets a tax-free allowance for capital gains, and for the 2025-26 tax year, that allowance is £3,000. Think of it as a head start. The first $3,000 of profit you make is totally tax-free. You only start paying tax on anything you make over that amount.
So how much tax are we actually talking about? Well, this is where it gets interesting, because the rate isn't the same for everyone. It's actually tied to your regular income tax band. If you're a basic rate taxpayer, you'll pay 18% on your profit. But, and here's the kicker, if that profit, when you add it to your normal income, bumps you up into the higher rate tax band, then you'll be paying the higher rate of 24%. It's a really important distinction.
Okay, theory is great, but let's make this real. Let's walk through an example. Step 1, figure out the gain. So say the probate value was 300 grand and you sell it for 340 grand. Simple math, that's a £40,000 gain. Step 2, you get to deduct costs. So things like your solicitor fees, your estate agent fees. Let's say that's 5 grand. Now your gain is down to 35,000. Step 3, knock off your tax-free allowance. That's another £3,000 off, so we're down to a taxable gain of 32,000. And then finally, step 4, you apply the tax rate, either 18 or 24%, to that final number.
And, drumroll please, for our fictional graphic designer LON from Cornwall, that calculation leads to a final tax bill of £6,463.80. Ouch! That is not a small amount of money, right? It's something you really have to plan for. But here's the big question. What if she could have legally paid less? Well, she could have.
Okay, now for the part you've probably been waiting for. We know the rules, now let's figure out how to play the game. We're going to look at some powerful and, let me stress, completely legal ways to slash that tax bill. Think of this as your CGT busting toolkit.
All right, the number one most powerful tool you have is something called private residence relief, or PRR for short. The rule is actually pretty straightforward. If you lived in that inherited property and it was your main home, even for a little while, you might be able to wipe out the entire tax bill. I'm not kidding. This one relief is a total game changer.
Just look at the difference it can make. Let's take Jago, a cafe owner in London. He inherits a flat. Now, he could have just sold it straight away and faced a tax bill of almost £8,000.
Instead, he moved in, made it his main home for just 1 year, and then sold it. Because he did that, he qualified for full private residence relief. His final tax bill? A big fat zero. Nothing. That one simple decision saved him nearly $8,000. Incredible, right? Okay, here's a quick pro tip for you. This is a really good one if you're married or in a civil partnership. If you own the property jointly, you don't just get one tax-free allowance, you get two. You can both use your £3,000 allowance. So bang, that's a £6,000 tax-free gain right from the start. That can make a huge difference.
You know, when it comes to tax, timing can be everything. Here are 2 clever little tips. First, think about the tax year, which ends on April 5th. If you can, maybe exchange contracts in March and complete the sale in April. It's a bit tricky, but it could let you use 2 annual allowances instead of 1. Second tip, look at your other income. If you're due a big bonus at work that's going to push you into that higher 24% tax band, could you maybe ask for it to be paid in the next tax year? Keeping yourself in that basic rate band for the year you sell the house could save you a chunk of change.
All right, so you know how to calculate the tax, you know how to reduce it, but all of that is useless if you miss the deadline. And let me tell you, this is a whole other battle. HMRC is not flexible on this stuff, so let's talk about the paperwork and the all-important timelines.
Okay, everyone lean in for this one. This number is unbelievably important. 60. That's it. You have just 60 days from the completion date of the sale. Not 2 months, not around 2 months, exactly 60 days. In that time, you have to report the sale and pay the tax you owe to HMRC. It is a crazy tight deadline, and it catches so many people by surprise.
And if you think you can just miss it by a little bit, think again. The penalties are steep, and they start immediately. You're hit with a £100 penalty straight away, even if you don't owe any tax. If you're 6 months late, it's another 300 quid or 5% of the tax due, and it just keeps going up from there. Plus, they charge you interest every single day it's late. Just ask Tamsin, a retailer from Liverpool. She had a crisis at work, missed the deadline, and it ended up costing her hundreds of pounds in completely avoidable penalties and interest.
Phew. Okay, that was a lot of information I know. So let's just take a breath and pull it all together into a really simple cheat sheet. If you're going to remember anything from this, make it these next few points.
So here it is, your CGT cheat sheet. Point 1, when do you pay the tax? Only when you sell, not when you inherit. Got it? Good. Point 2, what's your tax-free allowance? £3,000 for the 2025-26 tax year. Point 3, what are the rates? It's 18% or 24%, and it all depends on your income. Point 4, what's the biggest way to save? That's private residence relief if you've lived in the property. And finally, point 5, what's that killer deadline? 60 days to report and pay. That's it. Burn those 5 points into your brain.
Look, what we've given you here is a fantastic starting point. But the truth is, everyone's situation is a little bit different. The numbers can get tricky, the rules for reliefs have fine print, and as we saw with the penalties, getting it wrong is, well, it's expensive. That's honestly where getting some proper professional advice can be worth its weight in gold.
So, if you want to be 100% sure that you're getting all the numbers right, and more importantly, claiming every single penny of relief that you're entitled to, the smartest move is to talk to an expert. For advice that's tailored specifically to you, you can get in touch with us here at My Tax Accountant. You can reach us on WhatsApp or by phone on 07854 255 375, or just drop an email to info@mytaxaccountant.co.uk.
And really, that leaves us with one final question for you to think about. Remember Jago and his £8,000 tax bill that vanished into thin air? With the right advice, could that be you? The savings can be genuinely life-changing, but it all starts with knowing what's possible.
We really hope you found this breakdown useful. It's a tricky topic, but hopefully it's a bit clearer now. For more essential tax tips and simple guides just like this one, please do hit that subscribe button for the My Tax Accountant YouTube channel. Thanks so much for your time today.